Welcome back to another episode of the Stock Market Open. Well, Tesla cuts prices again, and we get retail sales data today. Ooh, it's going to be a juicy day. Tesla just slashed the price of the Model Y in a lot of European countries just after we saw prices of the Model 3 and Y get reduced in China. Tesla stock down a little over 1% in the pre-market. In Germany, which is actually where we're seeing some of the Giga Berlin shutdowns, in Germany, we saw the Model Y get cut by anywhere between 4.2 to 9.1%. The Model Y long range and performance variants were cut 5,000 euros each, and the standard range model was cut about 1,900 euros. The Model Y inventory has popped up a little bit in Europe as well, basically every quarter since the beginning of last year, and so it looks like they're trying to get rid of some of that additional inventory. Although it's not just prices, Tesla also is now offering 0% financing, which means Tesla's got to pay for that and take it in the margin. Not great. Definitely waiting for those rate cuts to bail Tesla out because it's become a little expensive. But that's okay. It'll get there eventually. In the meantime, we have retail sales data coming out. Retail sales data comes out in just a few moments here, and we'll get to explore some of the joys of what retail sales data do for the stock market, which either lead it to go up or lead it to go down. Retail sales, we're expecting to get a month-over-month move of 0.4% in retail sales data. Remember, when we get numbers that are too hot, they signal to the Federal Reserve and to markets that, oh no, the Federal Reserve is going to have to do more and stay higher for longer. Realistically, the biggest thing the Fed's looking for right now is what's going on with inflation, and the biggest, baddest foe in the room would be some kind of rebound of inflation. That's why this upcoming inflation data set and CPI revision set that we're looking for in in February, as Waller alluded to yesterday, will be a pretty big deal. So we'll cover those. But today, to sort of help us get on the track of understanding where the Federal Reserve is with how much pain there has been in the economy, we will also be getting the Beige Book. So in addition to getting a retail sales here in the next minute or two, we are going to get import-export prices. We'll get industrial production numbers. Those are all coming out today. But we really want to pay attention to the Beige Book. And that Beige Book comes out at about 11 a.m. So I'll cover that in substantial detail today. And then we'll probably post the edited version of that document on good old eHack. So with that said, we've got some deliciousness coming up here within the next minute. We'll cover that. In the meantime, it does seem like markets are down in anticipation of this retail sales release, with the exception of Instacart, which is up almost 4% there. Let's see what's going on with Instacart. And we've got most stocks down. Nvidia's up about 0.5%, but then again, Nvidia ain't no most stocks. Instacart update his customers to see new fees from OPEX increase. Customers outside of Seattle won't be able to order instant cash payout, no longer available in Seattle. So some changes in Seattle, along with some potential new cost increases. Interesting. I'm not sure why that moved the stock 4%, but anyway. All right, here we go. Let's get some retail sales data. Digital, what do we got here? DWAC down about 8%. That gets traded on election news. All right, anyway, here we go. Retail sales coming in at, okay, wow, yep, we got a beat. So retail sales were expected to be 0.4%. We got 0.6. There's that going to be that higher for longer again. You've got New York Fed business activity coming in at negative 9.7. You've got retail sales ex auto month over month coming in at a beat. Instead of 0.2, we got 0.4. Retail sales ex auto gas, we got basically twice the result we were expecting. We were expecting 0.3, we got 0.6. All way hotter than expected. Retail sales control group came in at 0.8. That's like 4x expectations at 0.2, way hotter than expected. Import prices month over month were expected to come in down 0.5%, came in flat. Import prices ex petroleum came in flat, expected to be up 0.1, came in flat. Import prices year over year came in at negative 1.6%, under the negative 2% expected. Export prices came in at negative 0.9%, lower than expected, and export prices year over year negative 3.2%. So, how's the market going to move on those retail sales? And then we'll get the retail sales numbers and figure out what are the actual details of it. Well, it looks like the NASDAQ is going right down to its Fibonacci, down to 4.06 here, or sorry, 406 is the number for the Qs. That's your triple Q. Retail sales numbers are a Census Bureau release. We'll be going through these in detail. We've got the report and the table right here. I'm pulling that up right now. But so far, all of these numbers hotter than expected. The inflationary numbers, though, seem relatively aligned with expectations, which is fine. So what do we have here? Census Bureau announced the following advance estimate of U.S. retail sales. I like to go kind of jump down to the table here. Okay. All right, let me get that working. Let's listen into this guy for just a moment.
On the headline number, month over month for December, much better than expected. We were expecting down 0.5. Well, they're unchanged. So I guess better is in your interpretation.
Yeah, I mean, he's just reading the same numbers we just saw, so boring. I'll just look at it right here. Okay, here we go. So we've got furniture. Okay, so I like to look at the month over month change, which is kind of a funky column. You have to look for the adjusted 2023 December number, but there's also a chart with a percentage that makes this a little bit easier. And let's see here. We could do this. Okay, yeah, there we go. That make this easier. December from November or last year. Okay, so month over month versus last year. Great. So the first two columns are what we could look at. So what did we see? We saw going from the bottom up, food and drinking places flat. So food and drinking places flat month over month, but up 11% year over year. Non-store retail, which would be like online, is up 1.5% versus the 9.7% year over year. Miscellaneous store retailers up 0.7 versus 6.9% year over year. General merchandise stores 1.3% versus 3.3. Sporting goods 0.3 versus 0.9. Clothing and accessories 1.5 versus 4.3. Gas stations down 1.3 versus 6.6. Health and personal care stores turn negative. Ooh, that makes you wonder what's if you're going to get any kind of outsized reaction in some of the companies like Ulta. Yeah, Ulta on these numbers dropping about 1% there. You could see that kind of move in pre-market, although I feel like some of the pre-market data is really missing here. But anyway, at least what we're showing on Ulta here, they're down about 1% in pre-market. But then again, so much is down 1% in pre-market. I don't know if that's really a horrible surprise. Q's really sitting right on that 406 Fibby here. Anyway, motor vehicle parts down up 1.1% month over month, up 10.3% year over year. Furniture and home furnishings down 1% month over month, and then negative 4.7% year over year. Electronics down 0.3% month over month, up 10.7% year over year. Building materials and home goods up 0.4 and down 2.3 year over year. So what did we really find here? Well, it looks like people, frankly, are spending less money on health, gas, furniture, electronics, but they're spending the same amount of money on food and drinking places, but they're spending less money, they're spending more money rather on clothing. That somewhat reiterates those American Eagle beats that we saw in the Lulu beats. Spending more money on motor vehicle parts, building materials again, as home prices stabilize, and general merchandise. Look at department stores. Department stores really popped up over there. 3% in the month. That's pretty wild. 3% on department stores. Wow. Okay, looking at the Qs. The Qs bouncing off the Fibby Yeah, construction everywhere you drive. Yeah, no kidding. That'll definitely contribute. But anyway, yeah, it depends where you are as well. Some areas it's a whole lot easier to build than in other areas. So you look at like California, it's like I don't know, it's a little tough to build out here, you know. Then you want to go out to like Texas, and it's like oh my God, a lot of building out here, which is a pro and a con, right? If you get an oversupply of building, you're going to drive rents down, which is like fantastic if you're looking for a cheaper, newer place to rent. But it's not so great if you're a developer trying to sell buildings. It's fantastic if you're trying to buy buildings like House Hack. Yeah, there's some real opportunities out there regarding that. But yeah, you've got to be careful of the overbuild side too. But anyway, yeah, look, export prices coming in with these negative reads, I think is fascinating. The export prices, we're basically exporting more deflation than we thought, but we are definitely importing either no inflation or year-over-year deflation. So again, these numbers are good. To me, I know markets might react negatively to some of this information. I think that's a mistake. I think it's very important to look at this and say, okay, look, we are in a situation where if we get a jobless recession, we are going to have a nasty, nasty time in not only markets, but also in the economy. And it's really bad. So what would I prefer? Well, I prefer to have strong retail sales, strong job numbers, and inflation that's gone, frankly. So, and I know there are a lot of folks, I see it in the comments, people are like, oh, what do you mean inflation's gone? It's nowhere near gone. Yeah, true, in terms of the inflation that we've had. But I feel like I have to say that every single day. It's the same thing every single day. It's like, yes, we had a lot of inflation. I get it. But that does not mean we are continuing to have inflation. Those are massive, massive differences, and they are very, very valuable for us to pay attention to. With that, let's take a brief listen and see what the folks over at CNBC are saying. If they're not saying anything, we're going to go to what Suits are saying.
Exogenous event to have something like
No, they're talking about mergers and acquisitions. How could they get off retail sales so fast? It's because they had a guest, so they had to dump the news and start talking, pumping up Morgan or Goldman Sachs. All right, let's see. We are going to have inflation every time a new home loan is signed at these prices. Yeah, I don't really agree with that. I mean, I think you've got a company or a country that, home prices went up a lot, but they kind of went up with inflation if you look at the measures, it's pretty wild. Maybe a little bit in excess of inflation. Anyway, how long until Spirit files for Chapter 11 bankruptcy? Yeah, no kidding. That 47% drop yesterday was insane. It's pretty insane. How often are ETFs adjusted? Well, I mean, it depends how often ETFs are adjusted. So, you could have a set allocation, and then every day you could have any kind of cash inflows just go into the same stocks. Some people send buy alerts for that, but if you're allocating the same stuff, what's the point? Changes in allocation. I personally am not a big fan of constantly changing allocations in ETFs. I kind of like what's your long-term strategy, But no, I mean, I would say probably every 2 to 8 weeks. It just sort of depends, when the facts change. So, anywho, what else do we have here? Let's see here. Yeah, Tesla's down another 2% this morning. Then we've got Trade Desk down 1%. You've got the Qs down 65. You've got Bitcoin sitting down about 0.4, big deal. It's been stable pretty much around that 42 fib. Apple down 1%. You've got a lot red today. It's mostly red. I mean, even Adobe's down 1% today. Wow. Let's take a peek at the Suit commentary on retail sales. So let's see. Oh, I want to see what's going on with the Treasury yields too. So that's a big deal. Let's see. Oh, wow. Yeah, okay. So we're almost at 4.1 on the 10-year. And 10-year, let's see. And then let's look at the 2-year. 2 years sitting at 4.32, so we're about 22 basis points inverted. Whew, excuse me, 22 basis points inverted there, and yield's definitely higher. Yeah, 4.1 on the 10. That's wild. Okay, so I mean, to think that we ended the year at like 3.8, and all of a sudden, for in my opinion, no reason, we're back at 4.1 is just wild. How's oil doing? Because I know the Red Sea drama is still bugging people. Oil's been volatile, down a couple percent this morning on less stimulus in China. Yeah, I mean, what a surprise. It's like the definition of China for you, less stimulus. Anyway, all right, let's listen to these suits over here.
But the tails, there's some tails that don't look great. So you think about the tails.
You have to believe that there's free lunches.
Tail?
That's Jamie's point. We had ZERP for 10 years. We got $34 trillion in debt. Gosh, rates are coming down. We conquered it. It's a soft landing. Let's spend another $34 trillion, and maybe the market will double from here. I mean, things like that don't happen, David. So just in general, there's got to be some reason for wondering whether it's too good to be true.
Well, I think you should, and that's why I think you have to be cautious. And I would highlight exactly what you just highlighted, Joe. I'm very concerned about the growing debt, and that's not something that I think is going to come home to roost in 2024 necessarily. But
How
the
can
velocity
rates come down when the government's going to have to borrow so much money for debt service?
Well, that's one of the reasons why I'm more in the camp of, higher rates longer as a general base case as you operate over the next 5 years, because we have to refinance this debt on a different basis than we have. Now, that doesn't mean the policy rate can't go a little bit lower, but ultimately, the burden, we go back to pre-financial crisis, you had $6 or $7 trillion of treasuries, you're now in the low 30s. And by the way, you're in the low 30s with a lot of short-term financing and, higher cost financing coming, which obviously grows the treasury stack. So I think that is a big risk issue that we're going to have to deal with and reckon with. It just might not happen in the next 6 months.
We got to run. But how do you think about China? The premier's here. Lots of discussion about what it means to do business in China, given the situation with Taiwan ongoing. They seem to be very open for business. I argue in large part because their economy seems quite challenged. But there's questions about, whether companies should be taking TikTok or ByteDance public. We just had Bill Ford on the program yesterday. Shein wants to go public. There's a question mark about whether the SEC will even let that happen in the United States. How are you thinking about China as given where you sit?
Well, I agree with your high-level thesis that the Chinese economy is slow and sluggish right now, and certainly they have a strong incentive to try to repair that, but they've got some significant headwinds. The U.S.-China bilateral relationship is probably the most important, bilateral relationship we have, and also the most complicated and the most fraught. I'm encouraged by the fact that there's been more dialogue in the last few months between the administration and the Chinese leadership. I think that's important. But I'm also eyes wide open that we're going into an election cycle where there's going to be an enormous amount of rhetoric that's going to be very, very tough. And I think it's going to be hard to understand the direction of travel on policy from here until we get past the election. We continue to invest in our business. We're very cognizant.
Yeah, I disagree with that. I think you get some nice fat slashes right before the election.
Restricting capital flow and investment into China. And so we look at our business with a different lens because of that. But where we can and we will, we'll serve our clients, especially our global clients who operate in China. We have lots of clients who operate in China, and we're very committed.
Navigated a couple of rough quarters, and you had a great quarter this time. Are you getting love letters from the board? Are you, did you get a new, 18-year contract or something? Is it different? Does it feel different?
Unfortunately, I'm an employee at will. I don't get a contract. But
weathered this storm.
What feels good is our team, Joe, did an unbelievable job. It was a tough.
Yeah, whatever. Okay. All right, so, let's take a look at here how markets continue to react to the retail sales beat, which continues to reduce the markets continue to reduce the odds of a March rate cut. Although I thought the March rate cut would have been unpriced a while ago. It's actually surprising how it's frankly still, priced in. I do think we're going to see way more cuts than expected this year. But you're definitely seeing way more optimism than I thought you would have had for the March rate cuts. March rate cuts now sitting at pricing of 59.7%. 59.7%. That's down from about 80%, frankly, yesterday morning. Qs just dropped past their good old Fibby here at 406.60. Might lead to some more short-term pain here in the stock market. You've got even Apple down another 1.2, dropping through its Fibby here as well at 181. Ooh, CrowdStrike's down 1%. Crocs are down 1%. Wayfair's down 3. It's interesting. Wayfair's down 3 on retail sales. Retail sales coming in with such a beat, especially on the sector that would include e-com, is a little surprising. But oh yeah, how interesting! Wow, that is so weird. Literally, 30 seconds after I say it, traders are trimming bets on March rate cuts and now see the probability below 60%, down from 80%. Yup. Anyway, let's see. Okay, little suggestion. Okay, what is this? December retail sales were also strong. Well, okay, sorry. We just got the December retail sales. Last month's retail sales were also strong, rather, for November. Strong control group was particularly notable. 0.8% gain is the strongest since July. Ooh. Plus, November activity was revised up slightly. Ooh, let's see that. November, let me look at the revisions. For the control group, yeah, you went from 0.4 to 0.5. That's true. And then import prices were actually revised down from negative 0.4 to negative 0.5. So it's so interesting. You have this very nice duality, dare I say, which is a good duality that you want, of lower price pressures but a stronger economy, which again, it's so weird how could it be propped up like that, but it is somehow. Okay, next data that comes out is at 6:15 California time. We'll have industrial production, capacity utilization. We will have manufacturing production at 7 a.m. We'll have business inventories, a little less critical here. And then at 11 a.m. we will have the Beige Book. And the Beige Book is really going to show us some reporting from the Fed, what their contacts are saying about the state of the economy, which is pretty useful, quite useful to see that. Okay, so retail sales led by auto, food, gas station. Well, gas station was slightly negative, so I disagree with that. Double check that. Fact check. Gas stations. Gasoline station. No, gas was negative across the board, so I don't know why somebody would suggest that. Disagree with that. But that's all right. So, yeah. Okay, 2-year yield rises 10 basis points. Yup. We've got okay, yeah, and I don't know why I have to see this, but now I have to show it. So, geez, that's pretty awkward. Okay, hold on. We get. Let's see if we can put this up. All right. So, yeah, there's this political commentator. His name is Dick Morris. He's an author and he's a campaign consultant. But what's interesting is he was also an advisor to Bill Clinton, and people are now, I guess, circulating this video, and they're like, it's a little awkward when some dude in underwear basically walks by while you're on an interview on Newsmax. Yeah, and I don't know why that's so popular to share right now, but I did also, so. Okay, so where were we? Well, I guess we're trying to find out what some of the suits are thinking. And so let's explore just that. We've got, that's interesting. That's kind of what I thought a lot of the suits would think about Waller yesterday. Getting commentary here that folks see Waller as basically having pushed back against cuts, concluding that let's see here, basically in prior cycles, the Fed could react quickly and reactively, or would cut quickly and reactively in the face of a recession. However, that here they might be able to gradually cut rates. I still think that's a delusional opinion that the Fed will cut slowly. They'll cut slowly for a little bit of time, but they've never done that in history. So you're probably going to see some bad jobs report or whatever that just leads the Fed to come out and cut very rapidly. So let's see here. Oh, how interesting. Here's Standard Charter. Oh, this is interesting. You have the duality going on in markets right now. It's not just some suits that suggest that you're going to get fewer rate cuts than markets are anticipating. There's this duality of some suits that are like, no, we actually think it's going to end up being worse, and you're going to get more rate cuts. It's more in the camp that I'm in, mostly because I think inflation is so far gone in terms of new inflation. But look at this. We are changing our Fed policy rate forecast to add 2 more 2024 cuts, one at May or June, and the second in Q3. Our Q2 forecast for top end is 5.25. That's for the top end, so that's your one cut, and then down to 4.75 for the top end, and end of Q4. Well, that's interesting. Forecast, hold on. Our end of 25 forecast is 3.5. Well, okay, so Standard Charter actually, while they added 2 more cuts, it doesn't seem like they were pricing in many cuts at all in the first place, because 4.5% on the top end puts you at 4 cuts. Okay, so they were pricing in 2. So they basically went from 2 to 4. Okay, that's interesting. It's important. Something that's going to be confusing here is there's an effective upper bound. If, okay, I don't want to confuse that with the zero bound, the effective lower bound. So let me say this. When the Fed sets policy rate, there's a range. And so right now that range is 5.25 to 5.5. And the point here is they're referring to the upper portion of it. A lot of people will actually refer to the lower portion of the range. It's kind of like when we were at 0. The range was actually 0 to 0.25, but everybody just refers to the lower bound. So it's a little odd that they're referring to the top end. But anyway, let's see if they give a reason why. We could see a case for faster cutting if core inflation looked like it was going to go below 2%, or growth and unemployment were going to point to a hard landing. Yeah, so my opinion, just my opinion, it could be totally wrong, but I'm always going to give you my opinion, even if it's unpopular. My belief is that you're actually going to see core inflation come in lower than expected, and you are going to see unemployment start getting hit. In fact, there was a piece this morning I was reading. Oh, it was talking about employers. Let me see here. It was actually really interesting. Oh, let's see here. Oh, here it is. Got it. Okay. Bonuses down 21%, showing that employers are gaining leverage. U.S. workers are gaining smaller bonuses, a sign that belt-tightening employers aren't as concerned about losing talent as in recent years. Let's see here. What are you talking about, Hi-Ray? That's not what I said at all. I think it's funny when people say, like, why'd you say this? I didn't say that at all. Can you speak to the job report revision? Peter Schiff is saying they're going back and making downward revisions of magnitude. Yeah, so I actually am going to meet Peter Schiff at his house in, a couple weeks. And so I can confront him in person for you. Nothing like a good morning coffee with a little, milk. So, cheers. Good morning. So, Kevin, can you speak to the jobs report revision? Peter Schiff is saying, yeah, okay. So let's break down a few things here. First of all, I didn't say that Canadian housing market was going to collapse this summer. Go watch the video again. But the interview with Lauren Southern was actually very good. I think she has very interesting perspective, and there was this insight that we've gotten out of her that I feel like we'd never seen before. This side, it was really sort of like humanizing, which was a great experience. As far as then let's hit bonuses and Peter Schiff. Okay, so regarding Peter Schiff on the jobs revisions, yes, during very challenging economic times, it is very, 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 very common for numbers to get revised all the time. And there are two reasons for that. Reason number one is the data is rigged. Reason number two is the data is very hard to gather in difficult economic times. And so, by the nature of data releases, we have to go back, and as new data comes in, we make revisions. Remember that employment data comes out the first Friday of generally every month. And so you're using employment data from usually the middle of the prior month. Well, what happens when you get data that comes in the last 2 weeks of the month? Well, you have to incorporate that at some point, right? So you make a revision. And sometimes the data that comes in at the end of the month is worse. And so you make revisions down. That is common in a declining economy. So now you have to look at this and say, okay, the data is either rigged or the data lags, and in tougher economic times, there are more changes and therefore more revisions. Or you look at it and say, it's probably some of both. And that's probably the reality. It's probably some of both. It's probably not all of one. So, yeah, I mean, I guess let's go back for a moment. Let's go look at the last jobs report. So, well, 2 jobs reports ago, we had, let's see, change in non-farm payrolls. Going back, change in non-farm payrolls. Okay, where is it? Bro. This is so hard. Okay, here we go. Yeah, I mean, look at this. Okay, so if I go back to the December 8th release, I get a survey of 185. We get an actual read of 199. But the prior release was revised 45,000 jobs down. So the release we got in November was revised from 150 down to 105. Okay, so 45,000 job revision down. So and then they say we beat in the last jobs report, right? 199 versus 185. So then we scroll over to the January data release. January data release comes out on the 5th. Change in non-farm payrolls. They say, oh, we're expecting 175. We get a beat of 216. But then they go back to the 199 of the prior month and they drop that back down to 173, which 173 would have actually been a miss. So you go back, the expectation was 185. So you revise under the expectation, right? But you do that after the news. So again, it's either rigged or it's just the way the data comes in. Again, the jobs report comes out usually the first Friday of every month. So when you actually read some of these reports, you'll find that the data is collected, like the second and third week of the month prior. Let me see if I could find, for example, in the last labor report when they say, sometimes I can find it very quickly. Sometimes I have to just read the whole damn thing, and it's not worth doing on a live stream here. I don't think I'm going to be able to figure it out very quickly right now. December, call. Usually you're looking for calls, which, yeah, I'm not going to be able to figure that out really quickly. But yeah, anyway, somewhere, survey data. Yeah, no, it's not going to be super fast for me to be able to get it. But anyway, I could go through some of the attachments and find it. But I mean, it makes sense. That's usually how it's done. I mean, you got to collect the data, then you got to collate the data. It's imagine a lot of work for these folks. So anyway, yeah, not the easiest job to be a data collector and then deal with the collecting and seasonal adjustments and trying to make. Because really, what you're trying to do is you're trying to have smooth data so that way you can understand inflections. But how do you have smooth data when things are constantly changing? It's a very difficult job. All interviews have been great, but hearing Lawrence say that Kev told her the housing market will collapse was a unique way to end the Lawrence Southern interview. I don't recall that. Everyone can verify. But hearing Kevin say the housing market will collapse. Yeah, I mean, I don't recall saying that. But okay, we'll have to go look at it. But anyway, Hector, are able to credit card delinquencies. You want to look at credit card delinquencies? The recent interviews we posted have all been very, very well done, very enjoyable, informative. Seriously, so many good things to say about that. Thank you for that. Yeah, I really appreciate them. Yeah, they're kind of honestly a pain in the ass because it's like, you know, flying to go somewhere and it takes like an hour to set up a studio and then an hour to take it apart. But it's also really enjoyable because it's kind of nice, like leaving the hole, so to speak, of the studio and going to meet real people face to face. I hate Zoom. Like, it's the same thing in real estate. Like, I just got to meet the people. So anyway, okay. So yeah, let's look at your credit card delinquencies and see what your complaints are here about credit card delinquencies. So here, credit card delinquencies, as you can see, they are rising. We are at a higher level of delinquencies than where we have been pre-pandemic. And the concern is the trajectory of this is getting worse. Kevin, after visiting Schiff, will pick up 1,000 ounces of silver bars. Yeah, I don't think so. Please review the decrease in tax receipts from 2022 to 2023 and the correlation of decreasing tax revenue and the resulting recession. It can be seen under Fred total federal receipts. Yeah, that's probably not a bad indicator. I'm not here to say there won't be a recession. I'm just here to say that most of the pain, I think, of the stock market is already behind us. Total federal receipts. So, could be wrong. Don't think I am, though. Too much money on the sidelines. Yeah, okay. So, what you're referring to is this. Oh, boy, dude. That's such a lagger, though, ain't it? I mean, look at that. Anytime you've had the declines, we've already been in the recession. I mean, the reality is, we might be in the frickin' recession right now. You know, that's the pisser. Everybody's always worried about the damn recession. But the reality is, they're just going to tell us, oh, yeah, we were actually in a recession. We didn't even know it. You know, looking back, and it's just like, it's so annoying because there's lagging data, and then there's just like, really lagging data. A recession is that. But yeah, I mean, look at this. It's actually a very interesting argument. Here, you know, well, let's do this. Let's get rid of all this tail on the left here. Oh boy, that does not sound like a that does not sound like I'm talking about a chart. But I don't know, maybe my head's in the wrong place. So anyway, what do we have here? So yeah, you get a decline in tax receipts as you go through the dot-com bubble, as you go through the recession, the Great Recession, COVID, and this time is different. Yeah, well, I mean, these are all the things I think that are going to lead into, we're going back to zero. Like, I know people think I'm crazy, but that's okay. I have set up my portfolio in a way where I think I will benefit over the next 10 years with not only my businesses that we're creating, but also my allocations to basically going back to probably lower rates than we had before, which will be, you know, I think a 10-year or a 30-year mortgage is going to be like 1.8% in 10 years. Kind of crazy. Why are they using incomplete data? Yeah, well, I think what you're asking for is why don't they just wait to finish gathering the data? Well, because there's a desire to get preliminary data as quickly as possible. So usually the first jobs report is actually just considered a preliminary release until it is revised. But, you know, that doesn't make the headlines. It's just the news cycle, man. People demand it. High Ray is convinced. Dude, whatever. Who cares, bro? You know, it doesn't matter, dude. Get over it. Do Patrick Bet David. I might stop by Patrick Bet David on the way back from Puerto Rico. So Schiff is a legend. Yeah, it's gonna be really cool. We'll see Schiff. We'll make some other stops in Puerto Rico as well. Revised lower. Isn't Coinbase versus the SEC today? Ah, yes. You notice that the bots are out of control. And maybe High Ray's a bot. So how long can we keep up a scheme? You'd be surprised. I think the Ponzi can go on for like 100 years. Yeah. Yeah, so we should be getting SEC v Coinbase updates. That is true, or at least a drop of the preliminary responses from the SEC. So I'm gonna log into Pacer and see if I can actually get an update on that. That would be very interesting. But that would be a catalyst today as well. So let's see here. What's your take on the SEC versus Coinbase lawsuit today? Yeah, I thought we were gonna get some preliminary notes in the AM. So I'm hoping to see that. I think Coinbase, or I think the SEC can give up on the Bitcoin ETF and still go after Coinbase. It'll be really interesting though. So Coinbase versus the Exchange Commission securities. I need a more recent lawsuit, don't I? There's the 2021. I think that's the one. And here's another one from, boy, there's so many freaking lawsuits. 2023. Let me see the 2023 one. So let's look at, oh no, let's go to docket. Docket, run. Okay. So, notice of motion, changing in counsel, bloody, bloody, bloody. Yeah, no, that's all. Nothing got dropped in that case. Boy, there's so many lawsuits against Coinbase. God, I'd hate to be their legal team. My lord. There are pages of lawsuits. All with their own nasty lists of docket reports. You have to pay money just to search this website. Alright, what do we got here? That has not... Okay, that's an order staying. Okay, so that particular case had a stay in June, so that doesn't matter. This case is closed. Okay, so it looks like the active case right now had its last filing drop on the 4th. Securities and Exchange Commission, no. My gosh, there's so many versus Coinbase. I feel bad. And Securities and Exchange Commission, that's the same one. I don't know why they show that one twice. I'll just double check. So, and yeah, okay. So the last thing was notice of public remote access. Hearing is scheduled for 117. Ooh, we should listen to the hearing. That'd be fun. I'm down to stream it. Okay, all right. Okay, let's see what I can learn in this. Okay. Oh. Let's put that there. Okay. Hearing is set for 10 a.m. Courtroom 618, 40 Folly Square, New York, New York. So if you want to go in person in New York, you got 52 minutes to get there. Mm-hmm. I want to see it. How can I see it? I don't know. Is it the Thurgood Marshall? Yeah, that's it. Thurgood Marshall Courthouse. Okay. Let's call him up. That'll be kind of fun. All right, here we go. 212. Okay. I'm just gonna get some stupid directory, I'm sure.
Record your message at the
What?
tone. When you are finished,
What garbage is that? Record your message at the tone. What kind of customer service is this? If I'm gonna call a courthouse, I expect some better customer service. They're definitely open. Yeah, that would be. See, I want to see the case. Anyway, so that case will take place in about 52 minutes. I'm sure if it's going to be streamed, it'll be somewhere. Sometimes these courts actually have a YouTube channel, and we could see. Let's see here. What's this place called? Thurgood Marshall Courthouse. No. Damn you! I'm calling again. Oh, it's ringing!
hello,
U.S. Court of Appeals.
Well, hi there. I was wondering if you're having a live stream of the case in courtroom 618 at 10 a.m. today?
Is this for a case in the Court of Appeals or the Southern District?
That's a really good question. It looks like this is in the... Well, it's in your Thurgood Marshall U.S. Courthouse. I'm trying to... Let me look at the actual filing here, what we've got in this. I have a case number for you, if that helps.
Okay, what is it, please?
It is 04738.
You're not certain if it's in the Southern District or... Because that's an old case. 04?
Yeah, but it's got a hearing today, yeah.
I mean...
Oh, well, the first... I mean, it's a 23... Sorry, I mean, I just gave you the last 5 digits. It's a 23 case, so it's 23-CV-04738. I don't expect this is in appeals. No, no. It's just SEC versus Coinbase.
This is in Southern District?
Yeah.
Okay, so I'm going to give you their phone number, okay? You're speaking with the Court of Appeals now.
All right, thanks.
Phone number is 212-805-0136. That's Southern District.
Great. Any extension I should use?
No, just that's the main line.
Cool. Thank you.
Okay, you're welcome. Bye-bye.
All right. Let's give him a try. I don't know this legal stuff. Gotta figure it out.
You have reached the United States District Court for the Southern District
Ah!
of New York.
Ah!
Clerk's office, located at 500 Pearl Street, New York.
0.
Zip code 1.
Come on. I know what's going on with
You
coin.
have reached the United States
No!
District Court for the Southern District of
All right, we'll listen to Jim Cramer while I figure it out.
From the get-go at this point, because there was so much regret that they allowed the American deal
Right. Well, that's what happened. I mean,
to
I
have
think that
occurred years ago.
but we have
Whereas
all
I
these
think the risk, Carl, to your point, is still there, both FTC and DOJ, for many deals that perhaps would not have been considered high risk. But as I've said a number of times, that seems to be fading as the key consideration for those who are considering a deal. We're back to sort of the basics of, can we agree on social issues and can we agree on price and can we get this thing to the finish line? I don't want to say in any way that regulatory risk is not significant, but CEOs seem much more determined now.
Yeah, well, Bob Bradway, who I spoke to last week, was the CEO of Amgen, and they're merging with they finished a deal with Horizon. Horizon had great drugs, but not a lot of distribution. Amgen's got terrific distribution. It's got a lot of money to be able to make more. And they went in front of the FTC, and the FTC was against the deal. And then they listened to Bradway, and they decided, hey, Bradway's right. We're going to go with the deal. And that was the beginning of the floodgate, was when people realized, well, wait a second, if you approach them with a reasonable proposition.
That said, we've got a couple out there still. And,
What?
I mean, Amazon iRobot, we'll see if that
Yeah,
ever
that-
can. By the way, the EU doesn't like it. I'm sure, I don't
That
think
is good.
Amazon,
I mean,
I don't
David,
think
that is
Amazon
good.
likes it either. Remember, they
You
got
are
the
going
price.
to dominate. They're going to dominate the robot
Vacuum cleaner.
vacuum cleaner, and that is one thing that is unforgivable. I want massive I want competition in that market.
Given what's happened to that company, Amazon, they already cut the price. Amazon might be happy to have them stop.
You know, they've been
and then,
arguing-
of course,
they
the
got the
Albertsons
mop.
deal
You have
that
the
we've
mop.
talked about a lot, which it's unclear when that's going to come up, but there's still a belief the FTC.
Making progress.
Washington State yesterday on that news. On
Yeah, I saw
Kroger
that.
Albertsons.
Yep.
Jim, really quick, 90 seconds before industrial production. This Waller speech yesterday and his line that we don't necessarily need to cut as rapidly as we have in the past.
Yeah,
Is that what sort of hurt the afternoon?
Yeah, he crushed the market. It was interesting. Both the Dow, which David, of course, will acknowledge is atavistic, and the NASDAQ both went down, but then the Mag 7 went up. The Mag 7, Waller couldn't hurt the Mag 7. He couldn't.
No.
He took a shot and he failed.
Everybody fails.
Everyone fails.
It's like the Van Wyck.
Well, you know,
you can't beat the Van Wyck. You can't.
Van
beat
Wyck?
The
What is
Van
it,
Wyck.
like
It's an old Seinfeld. Have you ever gone to Kennedy Airport? Has there
you
ever
can't.
not been traffic
You
on the
can't.
Van Wyck?
Just you can't get past the Van Wyck.
Can't beat the Van Wyck.
But I will say that people are start talking about the Mag.
All right. So industrial production numbers, we're looking for negative 0.1%. And I'm sure the second the numbers come out, I'm going to get back on the phone here. It's all right. So it's always how it works out. So we're looking for negative 1%. Here we go. And waiting for the numbers to come through. We're looking for capacity. Okay, here we go. We got positive 1%. Industrial production comes in at a beat. Wow. Manufacturing production also comes in versus 0, comes in at 0.1. And then capacity utilization comes in softer, 78.6 versus 78.7. That's less stress on inflationary pressures, better economy. Again.
On headline industrial production, the mirror image of the down 0.1% we were expecting. And just to put that in perspective, the number that we had in October was the weakest number going back to December last year at minus 0.9. So we have come up a bit. Now on utilization rates, expecting 78.7, very close to expectations, 78.6. The problem with that is 78.6 is a nice jump from where we were not that many months ago, but 78.6 is still pretty light when you consider we started out last year at 79.6. These numbers have been soft. Manufacturing has been on the soft side. What hasn't been soft is some of the inflation readings we're getting from Europe. We watched UK sovereign debt jump in yield. They've seen some real pops in some of their inflation numbers, which really demonstrates that it isn't necessarily a linear path, which may make many here a bit nervous. Late revisions coming across the wires as last month's up 0.2 on industrial production now becomes unchanged. Squawk on the Street will return after a short break.
Awesome. Thank you so much.
No worries. Have a great day.
You too, bye. Got it. Yeah. I suppose if we were so inclined to listen to the SEC versus Coinbase audio hearing, we could do so. I don't know, now I have to decide, do I want to? But anyway, okay, cool. So let's see what we got going on here in the pre-market after the industrial numbers. So let's see here. The Qs, oh, look at that. Trying to get back up to the fibbies here. So then we've got NVIDIA actually went flat. We've got Apple's down 1%. You know, these industrial yeah, why is everything so red? Yeah. You know, I mean, you have to remember the market goes in these cycles that aren't necessarily like, there don't have to be underlying reasons. Sometimes it's just like the trend, right? The trend is your friend. So you have to remember that about the market. Look at it. I mean, zoom out. You see when you have the average candlesticks, it's like it goes down, it goes up, 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 it goes down, it goes up. Like, it's the stock market. And if by now you're not used to down and up and down and up and down and up, I don't know, you probably shouldn't be in the stock market. I mean, look at it. Go back, you know, from COVID, same thing. Go back, look at this on a week chart. It's the same thing. It's always like this. Always. It goes up, then it goes down. It goes up, then it goes down. It goes up, then it goes down. It's just the way it works. So, you know, sometimes try to kill yourselves looking for all the exact minutia of reasons. It's anything. I mean, like the market, if it was trending up, it could be cheering these numbers today. I don't think these numbers are bad. I mean, think about it. Stronger retail sales with less import price pressures. More industrial production with less utilization. Folks, even a downward revision on prior capacity utilization. It's literally what I always talk about. I mean, look at where, you know, I had a rubber band yesterday and I'm like, I gotta save it for this specific reason. But anyway, I never do. But it's the analogy that I give all the time with the rubber band of like, you know, the supply chains have done this. They've been so developed. They're just bunched up and smushed up. And there's so much room to actually grow production and still have loose capacity, excess capacity. Excess capacity breeds lower prices. And look, I'm not saying there aren't going to be certain pricing pressures like with Red Sea freight, but that doesn't mean consumers are going to have to pay those prices. That means companies have to pay those prices. That means shareholders have to pay those prices. but that's often offset by better sales anyway. So yeah, okay, good. So now what? Oh yeah, we were gonna keep going with this right here. So to us, the key issue is how policy should react to soft landing. That is the consensus forecast. Market pricing suggests a Fed reaction function that takes policy rates quickly towards long-term equilibrium if inflation is at or near Fed target. Yes. We believe the case for a cautious pace of cuts is stronger if activity is not much below potential and inflation is not below 2%. The pace can be accelerated if the soft landing turns bumpy. Yeah. It feels as if the market is pricing policy rate cuts despite the data rather than because of it. Despite the data rather than because of it. Oh, okay. Yeah, okay. Fine. Recent labor and inflation data did not point to the need for accelerated cuts. Yeah, that's fair. I would agree that I don't think the data is screaming like we've got to accelerate. You're starting to see a turn in some of the data, though, right? Oh, yeah, which reminded me the bonuses piece. So U.S. workers are getting smaller bonuses. Average cash bonus paid to employees last month was $2,145, down 21% from the previous year, according to the payroll software company Gusto, which tracks payments made by more than 300,000 small businesses. Every industry posted a decline ranging from 3.8% for tech firms, 36% for tourism and transportation. Not only were bonuses smaller, but fewer workers got them in most industries. Small businesses employed nearly half of all private sector workers. Not only were bonuses smaller, but fewer workers also got them. 16 out of 22 industries tracked saw declines in the share of workers that received any sort of bonus. The biggest drop coming in arts and entertainment. Some of the industries where there were challenges in finding talent, like food and beverage and healthcare, I didn't expect to see the magnitude of declines in those sectors specifically. Well, yeah, I mean, those are the ones where I think companies are most quickly able to cut. Yeah. All right, so anyway, let's see what we have over here. So what is this? Our market forecast. Yeah, they are way behind on the rate cuts. That's interesting, and they added 2 more rate cuts. Fine, whatever. Okay, good. So what else do we have? Oh, let's, I'm trying to see quickly, do they have any real bear thesis here? Inflation break-evens up as nominal yields drop. Is that true? The inflation break-evens up? Let's take a quick peek at that. 5-year break. So 5-year break is, yeah, 2.23. I mean, we're up since the December low of like 2.09. But it's still relatively benign. Okay, so... What does the Fed know and what does it guess? Well, yeah, no kidding. That's the big question, is what's the, real neutral rate? That's the big debate, but that's also a boring debate. We'll see today with the Beige Book what they think, as well as, of course, the speed of inflation declines matter. Oh, they do talk a little bit about 50 basis point cuts versus 25s. Ooh. But that's going to require a little bit more data. All right. What's Jimbo saying?
I know. And it's not Bush. It's like,
no.
It's like Heine.
The body count in Reacher is very high. Very high.
Not in the actual books. In the actual books, people are beaten to a pulp, but they don't die.
Oh, they don't die.
Yeah.
He's just snuffing people
out. He's hands-on.
He's on your neck. All right, we got an opening bell a few minutes from now. Don't forget as well, you can catch us anytime and anywhere by listening to...
How could you forget? They do this at the New York Stock Exchange. I don't know if that's obvious, but it's kind of cool. Their studio is like right there on the floor, and they just have like a wall. And then as soon as Jimbo's done, they leave, and there's like no evidence, no cameras, there's nothing left of like their wall. But the big table stays there that they have. And then they have a little booth off to the side. All right, so bond knee-jerk reaction. Bond investors won't give up on the idea of rate cuts in March, and even though the December retail sales beat forecast, the thought is the January data won't, and that'll keep investors in buy-the-dip mode on bonds. Yeah, we'll see about that. So 10-year right now, I don't see by the dip. It's up 3.6 basis points. So I don't know what you're talking about, but okay. Let's see here. 10-2 curve has been inverting. Yeah, not really. Disinverting rather. We're still what, 20 to 23 basis points off right now? 24 right now. Yeah. So then we've got, okay, Fed pressing higher for now against markets lower and sooner. Retail sales data could further chisel away at the odds of a March rate cut. Yeah, I agree. I mean, so far all the data has been saying no March. I'm not so worried about that. I more think it'll be really entertaining when we get, like, summer cuts. JP Morgan's Jamie Dimon says he remains cautious in the U.S. economy over the next 2 years. You have all these very powerful forces that are going to be affecting us in 2024 and 5. Ukraine, terrorist activity in Israel, Red Sea, quantitative tightening, which I still question if we understand exactly how it works. Yeah, I think it's a mistake to assume everything's hunky-dory. When the stock markets are up, it's kind of like this little drug. We all feel like it's great, but remember, we've had so much fiscal monetary stimulus, so I'm on a little more cautious side. He's not wrong about that. A lot of stimmy money has been flowing into the economy. Jamie Dimon is not wrong. A lot of fiscal stimulus. It's basically government throwing money at Intel. That's my take. And TSM to some extent. But I want to see more of an Intel pump. Come on, man. Where's my Intel pump? I got a lot of it already, but I want more. I want more Intel pump. So, retail sales data today could further chisel away at the odds of a March rate cut. That's fine. What's this? Improving mortgage costs should keep retail sales supported. I don't know, man. Who's refinancing at these levels? Oh boy, I don't think anybody. Okay, I guess it'd just be more new buying, and that could lead to people spending money. Yeah, people buy homes and then they blow money on just stupid stuff. So, I don't like bigger homes. Anyway, all right, let's listen in over here for a moment.
Remember,
oh, there he is.
Fiscal monetary stimulation. So I'm a little more on the cautious side that we are facing a lot of things in 24 or 25.
That's Jamie Dimon on Squawk this morning offering his outlook on the economy. Jim said, don't assume everything is, quote, hunky-dory with the U.S. economy.
No, and I get that, and I think that he did present a little less perilous view. There was something I thought was misinterpreted by a lot of people this morning. I want to make this clear. He did not say, look, I think that Trump has a lot of good points. What he said was, please don't dismiss the people.
We don't need politics. We need babies. Look at that. One looks like Max. One looks like Jack. That's the one that looks like Max. And that's the one that looks like Jack. Those are two little twin girls. They're born, October 26th? They're preemie. They were preemie, but, so they're probably, like, technically a month younger than they should be. But anyway, a little baby update, I guess. So, is that a live shot? No, that's a yesterday shot.
People cared, the media cared, and then they listened, they decided they didn't care what the people had to say. What he's saying is, look, immigration, how can you not be worried about it? China, how do you, get NATO? They don't pay their freight. And I thought that was a very considered view of why would you write these people's views off?
I think the only thing missing from that conversation was any discussion.
When am I doing the interview with HUD 8? I actually have that on the calendar, I could tell you. I think that's the second or third week of February, so it's going to be a minute. Tentatively, the second week of February.
Yale is that we have to let the people decide, and he says that that's contrary to the...
Adam Newman's new real estate venture might default. Bro, it's Adam Newman. He went bankrupt on WeWork twice. I'm sorry. I don't understand people.
It is to dismiss the voters of Trump. Again, it's a mistake. That's what he said. He did not say...
There's still a lot of time between now and the election, but it is starting to figure into, without a doubt, asset managers' playbook for the remainder of the year.
And that's where I wanted to go, because why should we talk about it? Well, I think we talk about it because wealthy class does better in a Trump world. And that matters.
Let's get the opening bell here in the CNBC Real-Time Exchange. At the big board, it's Innovid, an independent advertising and analytics platform. At the NASDAQ, Cryoport, cold chain logistics services for life sciences. As breath rolls in pretty negative, Jim, actually.
It's so red, it's disgusting. It's fine. It's fine. Everything's fine. The bears love it when the market's red, though, because it just sort of reiterates the bear thesis. And then the bulls are sad when the market's red because it takes away the bull thesis. When the reality is, this crap just goes up and down. But it is kind of fun to look at and trade. So I'm really curious to see how that SEC... Like, I think the way to play it is you get on that call with the SEC and trade Coinbase. But anyway, so yeah, NASDAQ's going to be about negative 1% in just a hot second here. So we are, yeah, look at that rejection. Perfect rejection. You cannot have more perfect Fibonacci's. My Fibonacci's is just natching. I don't know. Whatever. Yeah, that's scary. So nice little rejection there. I don't know. Tesla ain't got no fibs left. They're out. I mean, they did close yesterday. Let's go to our non-average for a moment. Come on, touchpad. There we go. So yesterday, look at that. We closed slightly below yesterday, but not fully below. Yeah, that's not a good look though. So we'll see what happens for Tesla here in the short term. Anyway, let's go back to our average candle. There we go. All right, so yep, there it is. NASDAQ hits the negative 1%. And it's so interesting on strong economic data, right? But again, that's because the market has to go in and suggest to itself that, all right, well, if we have strong economic data, we must unprice rate cuts. There must be a lot of that going on now then. Let's take a look at that. So if I go to no, I don't know why I went to CoinMarketCap. Well, I guess I wanted to see Bitcoin really quick. 42.4. Okay, a little bit of a move down there in BTC as well. And then if I look at the rate expectations for March, we're now, yeah, we just cut a little bit more, 57.8 after that retail sales data, 57.8% chance. Adam Neumann created a secretive billion-dollar startup. It wasn't secretive. He literally got $300 million from Andreessen Horowitz at a $1.2 billion valuation. Oh, it's $350 million. Wow, it's even more than I thought. So like somebody threw $350 million at the sky. I don't understand. Gone bankrupt twice, bro. Just shocking to me. Anyway, yeah, this is very interesting. That's funny. Jason from All In tweeted, if a startup is worth $1 billion before it launches a product, it's probably a scam. Yeah. Like, wow, that's crazy. So where's the cash issue? I want to see this. Because I've been complaining about this startup for a very long time. So where's the money problem? Anyway, where's it? Oh, okay, here it is. It's basically they're trying to. What is this? Despite Flow's website announcing coming soon into Nashville properties, so they finally acquired Nashville properties. They later transfer, let's see here. They are experiencing a cash flow deficit, according to the Real Deal, real estate paper. To address this, two funds have been launched on the crowdsourcing platform Yield Street, aimed at gathering investments to manage interest rate caps and operating shortfalls. Wow. RIP. Oh, $60 million on a floating rate mortgage. Cash flow is sufficient to cover half of the monthly payments. Oh my gosh. Oh, dude. Enough cash flow to cover half the loan. No. Okay. All right. Enough of that. I can't read that anymore. I can't do it anymore. Strong spending supports consumer discretionaries. A big jump in non-store retailers bodes well for consumer discretionaries like Amazon, which could go a long way to help the sector recoup losses. Retail sales were strong across the board. Yeah, department stores honestly did well. I wonder how the department store stocks are moving today. I mean, everything must be red because this is what's green and there's like nothing. I mean, Boeing's green. And let's look at Target. No, Target's down. Target's down about 80 bips here. And Tesla's down a full 3 right now, sitting at about 212. Got Trade Desk down 2. Coin down 2. Even Intel down 2.5. Nice sell down. Oh, Rivian down another 5. Nvidia goes down 1.5. Yikes. Look at Rivian. Rivian just, wow. Rivian dropped a lot here. I mean, Rivian went from 24.7 to 16.7. 16.7 divided by 24.7. It's about a 32% drop. But then again, Tesla went to 212 from what, 258? It's only about an 18% drop. Yeah, Rivian's dropped almost twice as much as Tesla. Cloudflare dumps 3% here. Not really respecting my fibbies that well here. It respected the lower fibs pretty well. But I don't know what this mess is going on over here. And, oh, Costco's negative. Let's go.
Lost the lead.
Anyway, 1.6% for Apple. What else do we have here? Where's some deals? Do some trades. Here's Zim. If you want to look at some fibbies, it's also been a little funky with where it wants to trade. You could see the 15s working well. This one's not working too well. You're bobbing between the moving average, and it looks like 1353. Robin the Hood, Enphase. Let's leave the biggest losers today. Biggest losers today, Dwac. Dwac. This is ridiculous. Like, yeah. I mean, that's probably a fair short, frankly. I want to see some financials on this company. Let's look really quick. Wait, but it's still the SPAC. Do they even do, because I think they just delay the actual merger. So I don't think there are financials. I mean, I doubt there are. There's a current report. Oh, there was an annual report that came out, an amended annual report. Okay, all right. What could it possibly say? Statement of operations. Okay, so the statement of operations, bro, there's nothing for 2023. They're just restating their 2022 numbers. What trash? So they're giving you no updated financials. Oh, that's a scam. This is, what is this? This is just an update on the agreement. Probably basically just buying more time. Unreal. Scam. So, okay. What else? Then we have, wow, NIO. I mean, yesterday we did our NIO analysis. I just about vomited when we did our NIO analysis in the course member live stream. It's not good. But anyway, I was not expecting them to drop another 5% today. So, ooh, Tesla actually stopped falling a little bit. Okay. Let's just pretend we didn't see it. Growthy expectations there for SoFi. I like the company though. Like I can't really say anything bad about SoFi. I think they're doing all the right things. I personally don't love investing in the financials. Yeah, you're getting a little bit of a rebound right now on Tesla. I wonder if that's carrying over to the Qs. Yeah, barely coming over to the Qs here. What's going on with bonds? Is bonds causing this, or what's going on? What's bad about NIO? Have you looked at their financials? I suspect you have not. Look, I think NIO will be a fine play if the Chinese economy starts booming. but you have some mega fundamental risk here. You know, you've got less cash than you have current liabilities and inventory combined. So you're going to have to dilute or borrow money from the Chinese government, which just means diluting. And you're at 11% gross vehicle margin, which is good, but you're not operating profitable. I mean, they have gross profit of $200 million and operating expenses of like $900 million. And it's going to take a lot of growth to cover that OPEX. The OPEX is huge. Good luck. It's going to be a while. It's going to be a while, I think. So, I mean, when you actually look at the numbers, it's not that fantastic. Now, don't get me wrong. It could be the bottom. It could be the Chinese bottom. You know, I think NIO is nothing more than a proxy for investing in China. But if I wanted exposure to China, I'd just go for like, you know, you could have more exposure to like Apple, Nvidia, AMD, Tesla, and like American companies with financials that I think we can have a little bit more clarity on. That I'd even go for Starbucks, honestly, as Chinese exposure. But yeah, or the other thing is you could just bet on, you know, the MSCI China, you know, ETFs. So there are a lot of these. There is the Chinese tech one. That one's pretty popular. Chinese real estate. Let me see. What's the? It's like S-Web or something, or it's K-Web. K-Web, I think it is. Yeah, there it is. K-Web. That's the one people bet on, by the way. A lot of people bet on this one. This is like your internet ETF. Let me see what's in this. I'm sure Alibaba's in this. Like Alibaba keeps looking cheaper and cheaper, right? But that's also because the Chinese economy got reamed. And we were talking about this yesterday over Mai Tais. I mean, over on Office Meeting. And one of the things we were arguing about China. And I don't know China very well, but I know a little bit about China. And one of the things that I recognize about Chinese individuals is there is a culture of anti-debt. And so, you know, when you have a culture of anti-debt, and then you have new generations get absolutely burned by the Chinese government for taking on debt, what do you think you foster more of? Well, you foster even more of a culture of anti-debt. So you have a disaster of what you've just done to the consumer. I think you're going to lead to a lot of savings in China, less spending than anybody anticipates. And so I'm very concerned about the Chinese consumer, but I don't know. I don't know enough about the Chinese consumer to really speak knowledgeably of it. So I try my best to kind of stay out of it, just because I just don't know. I don't know China that well. But those are the things I would want to overcome if I was an investor in Chinese stocks. I'd want to have answers for those things, right? I think those things are important. So, anywho. Okay, good. So, K-Web. I was quickly going to look at some of these holdings. Holdings. Tencent, Alibaba. Yeah. Tencent, Alibaba. Bro, stop spamming me with your stupid pop-ups. Trip.com, Full Truck, Kanzun, JD, NetEase, Meituan, whatever, PTD. I don't even know what that is. So yeah, I mean, not a surprise. Alibaba's like 10%. So, yeah, I mean, those are just my thought. It's not like an anti-Chinese thing. It's just like, you know, I'm aligning less financial disclosure with, you know, Communist Party interventions with a culture that rewards savings versus debt. All of those things to me aren't great for consumption. Whereas in America, we have a culture that rewards debt. So when rates come down, things go up. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. There you go. Well, it looks like, look at the Qs. Look at the Qs dropping off a cliff. The Qs dropping off a cliff. Tesla, not that bad of a cliff, I guess. 2.5% is just a day in the life. Nvidia, yeah, Apple again. Yeah, I mean the trend is down right now, eh? Don't worry, there'll be an uptrend again. It'll come soon enough. All right, I gotta go pour another cup of coffee. Goodbye.